For years, some Albertans have wondered, would we be better off on our own? With rich natural resources, strong political will, and a growing sense of Western alienation, the idea of Alberta separating from Canada is once again on the table. But behind the headlines, the rallies, and the slogans, there's one question that matters more than any other. Who is going to pay for it? How much would independence truly cost? Part 1. The legal path to separation. Alberta cannot simply declare independence. Under Canada's Clarity Act, a clear majority of Albertans must first vote for separation in a binding referendum. Then comes the hard part, negotiations. Approval from the House of Commons, Senate, and all provinces. Formal agreements with Indigenous governments. It's a process expected to take at least 4 to 6 years, even under ideal conditions. Part 2. Let's talk numbers. Alberta's net debt sits around $36.6 billion, and its total bond liabilities exceed $67 billion. Annual debt servicing, over $3 billion, a number that will rise if Alberta separates and Alberta credit ratings fall. Referendum and legal costs, up to $1 billion. Setting up new institutions, currency, border control, pension systems, central banking, could cost between $3 to $8 billion. Part 3. The oil and gas equation. Alberta currently brings in significant royalties from its oil and gas sector. In 2022-23, royalties surged to over $27.5 billion, the highest in provincial history. But that was during a commodity boom. For 2025-26, the government projects about $13.3 billion in resource revenues, down nearly 50% from peak. Sounds like a strong safety net? Not quite. Much of that money is already baked into the provincial budget. It funds hospitals, schools, roads, and frontline services. If Alberta separates, that revenue would have to stretch even further to cover the loss of federal health transfers, full pension liabilities, border services, policing, defense, and diplomacy. Alberta also benefits from billions in federal subsidies for carbon capture, orphan well cleanup, and risk absorption on pipelines. These funds would disappear, and Alberta would either need to cover them itself or allow the oil patch to suffer. On top of that, the Alberta taxpayers already provides $1.622 billion annually in subsidies to the oil and gas industry, through tax breaks, royalty holidays, and direct incentives. And finally, there's geography. Alberta is landlocked. It depends entirely on pipelines and rail through British Columbia, Saskatchewan, and the United States. An independent Alberta would have to renegotiate every export route. That gives both Canada and the U.S. enormous leverage, potentially demanding tariffs, transit fees, or environmental concessions in return for access. Part 5. Would taxes go up? Experts estimate Alberta would face a revenue shortfall of $10 to $15 billion per year. Options: raise personal income tax by 20 to 30%. Introduce a provincial sales tax, increase corporate taxes, or cut deeply into healthcare, education, and pensions. Part 6. What are the gains? Supporters point to some potential benefits. Alberta would keep all its GST and corporate tax revenue, and Alberta would have to create its own Canada Revenue Equivalent Agency at its own expense. While separation might remove federal regulatory oversight, it would not meaningfully increase Alberta's control over its own resources. Alberta's $25 billion Heritage Fund could be used as a financial cushion, although it may be at financial loss, and less than 24% of the assets are liquid. It's estimated the transition to independence could take 6 to 12 years. During that time, Alberta would likely face budget deficits, rising debt, tax increases, and reduced investment. Part 7. Who wins? Who pays? Privatized corporations and energy giants could benefit. Without federal regulation, oversight, or climate targets, Alberta could fast-track extraction, reduce royalties, or offer new subsidies, transferring more of the risk and cost to Alberta taxpayers. That means more profit, especially if public services are privatized to fund the transition. Political players advocating separation may also benefit, earning power, platform visibility, and long-term influence. For some, however, The referendum is less about sovereignty and more about leverage, using the threat of leaving Canada to extract better deals from Ottawa. But for everyday Albertans, the taxpayers, workers, seniors, and families, the cost is real and direct. Higher taxes to replace lost federal funding, fewer services if budgets are cut, or higher costs through privatization. Greater exposure to volatile oil markets, years of uncertainty in pensions, trade, and healthcare, and limited power in global negotiations as a small, landlocked state. Yes, Alberta's oil wealth is valuable, but without federal support, shared risk, and international clout, that wealth doesn't go as far, and it certainly doesn't trickle down equally. If you've enjoyed this video, like, share, and subscribe for more fact-based breakdowns on Alberta's history and future. Thank you for watching.